Okay, greetings everyone, it's Sam here. In this segment I would like to tackle another question that was sent to me, which is actually quite lengthy. I hope you can read this. The print is rather small. If you can't read this, you will find the question actually in this week's tutorial. I'm very grateful to this person for writing to me with such an amount of detail. I think there are some interesting points that are raised here, and I hope that I will be able to unconfuse you or help to clarify some of your possible confusions here. So let's just please just take a moment to read this question carefully. You might want to pause your machine for a moment and read the question. Okay, I'm going to tackle the points one by one. Now, the first part, which is a question here. In the dividend discount model, the intrinsic value of a stock is quoted as the summation of all its future dividends discounted back different periods with different discounting frequencies or discounting periods, and it's also represented in this manner. Okay, and it looks like that they are the two equations do not look like each other, even though we note are the same. I think it's because the sum of dt 1 plus k are all included into the price of the next period, which is all the future dividends discounted to the time 1 is equal to P1. Yes, I would say that is true, but there are two different equations. Do I understand right? Yes, you do understand correctly. Let me just go to, okay, let me just start a new page. Now, let's just say, why can't I write on this thing? Edit. Just hang on a second. Okay, so what happens is that in the first equation, you've got the price now is the summation of basically all the future dividends, and then you just discount them back by using the discount rate over a number of periods. Now this is basically just let's say in the next period, so it'll be 1 plus k, and then the period after just 1 plus k, and then you discount by two times, and then all the way to eternity. So this is what you do. So all we are saying here is that, well, if you just keep this first one as it is, then for all the rest, okay, this would be equal to the price of one period after. And if you want to know what that should be today, you just discount it back one more period. So that gives you the next period. It's almost like this is trying to price equity like a fixed income, which I think is dangerous. So that's the equation. So this P1 just basically is just this thing over here, all of it. Okay, and then you just discount it back to today. Okay. Now, what's the next question? So your understanding is absolutely correct. Yes. Now, second, in the part we compare a value company and a growing company. I conclude that since the growing company enjoy a high level of return on equity and G, by the way, do ROE and G always move together? I guess they do. According to the formula that I'm about to show you, yes, they do. The company should not retain much earnings because the money they reinvest could earn more. But for value company, the ROE is relatively low. I'm confused whether they should retain earning or not. I don't want to. If you start introducing the value versus growth, those kind of empirical observations, which I think can be very ambiguous, I think it's not going to help the discussion. What I will tell you is this: if you were to look at I mean, it's very simple. So the growth rate of a company's earnings, okay, should be whatever is the return that you make multiplied by the retention rate. Now, let me make this very, very simple. So let's say the ROE of a company is currently 10%, and at the start of the first year, I give you $100 to invest. Okay, sorry, let's make it 15%, or 10%, 15%, and then your retention, your rate of retention is let's say 66% or 66.6. So you retain, not just retain, you retain and you reinvest 2/3 of whatever you earn. Okay, now if the rate of return on equity really is 15%, that means after 1 year, okay, you will have made $15 for the company, and let's just say if the retention, the rate of retention is 66%, so you're going to keep $10, you're going to pay $5 away as the dividend, and you're going to retain $10. Now, if this continues, that means that one period after you will have $110 to play around with, and if you can maintain the same return on equity, then of course you are going to make 15% on 110, which becomes 115% on $110 would be $126.50. So now you have made $16.50 in the second period. Okay, so your profit has grown from $15 to $16.50. Okay, now, so it's grown 10%. Where did that come from? It's simply whatever was your return on equity multiplied by your retention rate, which is 15% multiplied by 66.6. Okay, so this is a growth. And if you were to maintain the same dividend payout policy, then of course out of 16.50 you pay 1/3 of that, which is $5.50. So your dividend has grown 10% also. Okay, so this is the formula. That's why when you asked me earlier whether when ROE goes up, whether the growth rate will also go up. Yes, as long as B is not 0, then it will. But if you pay all of it out, then and you don't have any new money to reinvest, and then of course you don't grow. Okay. So I'm confused whether they should retain earnings or not. Okay, actually I can answer this question in a slightly different way, by addressing perhaps the last part of your question set, the last paragraph. During the course, lots of indicators were introduced, like Pvgo, PE, PEG. I don't really know how and when to apply them. Especially, I'm confused when to use the market consensus G or self-calculate G. Can you please cover a little bit during the next tutorial? Well, I'm going to try and do that here. Now, PE, there's nothing mysterious. I think these different valuation metrics are telling you different things. So you have to, I think it's not really very good. I just tell you, 1, 2, 3, 4, 5. Okay, use this for this reason, use that for that reason. If you actually sit down and start thinking about them a little harder, I guarantee you will get more out of it. But anyway, so PE is just, your, what are you, in terms of every dollar of earning, how many times you are paying for it. Okay, so if your PE is 20 times, then it would take you 20 years of earnings to cover whatever you are paying initially. Now Pvgo, it's something different, which I'll come to in a moment. Okay, but as to the question of whether you should use the market consensus G or self-calculate G, well, it doesn't. It's not limited to G. I think for anything to do with valuation, whether it's equity, whether it's bonds, whether you are trying to estimate bond yields or growth rates or return on equity, discount, anything. Okay, you will only have a different opinion from the market if you are using your inputs, your own inputs. It could be that when you are using your own inputs, you happen to agree with the market, which is fine. Okay, but it's only when you are using your own inputs and they are different from market assumptions that you start to have something interesting cooking. That is why I said, in the last tutorial, a good investment is, when everyone agrees with you later. Okay, so, that's supposed to be funny. Some of you didn't find it funny, but it's very true. It's only when you are departing from market consensus that you start coming up with your own, interesting and original thesis. Generally, okay, generally. Of course, you can't have your own risk-free rate, or if it's, well, you can if it's for a long duration. But if you're using the 1 month or 1 week risk-free rate, you can't argue with the market. So that there are some limits to what I just said. But mostly, I think your value as an investor, as an investment manager, or as an analyst is, to what extent do you disagree with the market, and how often are you correct? Okay. Now, let's just take a look at. So I'm gonna take a look at this passage here, for example, which is from lecture number 2. Now here, what's going on here? There's a company called Cash Cow. Okay, now Cash Cow is just a generic label that you would give any company, which is not particularly exciting. It's stable. It's been around for some time, and it's got a steady cash flow. A good example of that perhaps is a utility company. Gas, electricity, whatever. So it's pretty predictable what they will do and what the demand is like and so on. That's called a cash cow, because you get cash from it, but there are no surprises and everything is pretty much priced in. Okay, and let's say they earn so earnings are $5, and then they pay all of it out as a dividend, $5. So B is the retention rate. Okay, so B, you retain 0, and therefore G, the growth would be 0, because of this simple formula here that I just wrote down. Now let's just say K. Now K is the discount rate, and let's say K was 12.5%. Then you just discount the dividend by the discount rate, and the price that you get is $40. Now let's just say that the return on equity is also 12.5%. Now some of you have been asking me what is the difference between the discount rate and the return on equity. Now quite often the assumption, if something was priced fairly, reflecting all the fundamentals, these two are supposed to be identical. Okay, but what K is now, K is if I am an investor, okay, and I give money to a company, okay, this is what I expect to get back. Okay, so I discount everything by this amount, okay, because this is what I expect I will earn. Now return on equity is what actually ends up happening. So on the right hand side, you've got a company. So let's say they command the same discount rate, or the same premium, if you like. Okay, the same pricing requirement, but for some reason this company is able to earn you 15% for every $100 that you invest. Let's just say it can. Okay, for some reason it can do that. Then what happens here is, now in that case, suddenly you see that if that was the case, then for the cash cow, okay, even if you retain some earnings, if the ROE is the same as the discount rate, the pricing doesn't change, and you can figure this out because your dividend is now $2, and then there is a growth rate. Okay, but it doesn't change the price. Whereas in this case, on the right hand side, although you are discounting with a 12.5% discount rate, if the actual return on equity is higher, okay, you can see that the price that comes out is higher than the $40 over here. Now, what actually is that telling you? So how do we interpret this in in plain, straightforward English. So what we are saying is this: if there is a company, or if there are two companies, okay, and the discount rate that you would use for both of them would be 12.5%. But if one of them can only make 12.5% on equity, okay, then it pretty much doesn't matter what kind of payout policy they have, whether it's 60% or 40% or 25%. However, the moment a company can generate more profit than its required return on equity, okay, here there is an excess of 2.5%. Now that's when things get interesting, because then if they retain some part of their earning, okay, the retainment is not the key. It's retain and reinvest. Okay, so you keep some of your earnings and you reinvest in those growth opportunities, or you reinvest in your operation to make it bigger or whatever. Okay, then the valuation is higher. Okay, so here, if we were to reinvest 60%, okay, and the ROE really is 15%, then the price of this stock relative to the price of a stock where the ROE was only 12.5% would be $17 higher. Okay, $17 higher. Now, let me show you a little spreadsheet I put together. So here is just directly translating what I showed you just now. You can knock this out yourself in Excel. It will just take you 3.5 minutes. So here I have a so here's the earnings, so $5, and now if the retention rate was 0, then $5 earned, $5 paid, and here I have the discount rate 12.5%, and return on equity is the same. Now here, what I'm saying is, now watch this, okay? If these two numbers are the same, then it doesn't matter whether I retain no earnings, or 10%, or 20%, or 30%, or I retain all of it, okay? Oh, that doesn't work because you're dividing by 0. Okay, I retain like 99%. Your stock price is still going to be 40. It's 40 not because I've hard coded it, okay, but it's because of the simple mathematics. Okay, so as long as your return on equity is exactly the same as what investors would generally require, and which is the number they use as the discount rate, which I'm now putting in bold and with a square around it, with a border around it. Okay, as long as that is the case, you really shouldn't be the price wouldn't change. Now, the moment your return on equity drops below, let's say it's 10%, okay, now if you are the CEO and you still insist on retaining the earnings and reinvesting in your operation, now what you are doing is your return on equity is lower than what investors generally would expect when they are using a 12.5% discount rate. Now that is called, I guess, value destruction, and that would be reflected in your share price. And as you change this retention rate, let's say you change from 99% to 80%, your stock price will rise. Change it to 70, okay, or 60, okay, or 40, or 30, or 10, or just pay it all away, okay. Your share price. This is another way of saying, well, if you don't really have a lot of good ideas, if your return on equity is so poor, that you cannot meet investors' expectation as reflected in the discount rate, well, guys, don't bother. Okay, just pay us all the money that you earn. Now, the flip side of this is if you were able to make, and this is, by the way, this is kind of what you do see in some industries that have started to mature. You know, I think maybe in a few years ago, IBM was doing something like that. They just couldn't figure out. They didn't have any more new ideas on what to do with the money they had, or even Apple, you know, to some degree when they were buying back their stocks and so on, and paying back their shareholders. If you don't have good ideas to where to spend the money, okay, don't bother. So you hear a lot of you know, in the newspapers and on the radio, people talk about cash rich corporates. Cash rich is not a good thing. Okay, if a company has a lot of cash, it's not a good thing, because it's diluting the you know, the equity base, and they don't know what to do with it, and it would dilute the quality of your earnings. Okay, the cash doesn't belong to them. Okay, if it's cash rich, then just give the cash back until you can think of some good way to use it. So for example, so here, if instead of 10%, okay, so some other company has a lot of bright ideas and their return on earnings actually exceeds uh, investors' expectations, so they can earn 15% for the money you give them. Now, if this is the case, then the moment they start telling people, oh, well, we will retain some of it and reinvest, okay? So reinvest 20%, reinvest 30%, investors would like that. 40, 50, 60. Now, this was the price that you saw earlier in the in that lecture file, $57, 14 cents. Okay, relative to just not investing. Okay, now if this company tells you, okay, we have a lot of bright ideas and we can grow the company, and we plan to, you know, retain and reinvest 60% of our earnings back into new projects or into in expansion, that equals to a 9% growth rate, because 15% times 60% is 9%. Now that 9% growth rate in today's terms is worth $17.14, because this growth comes from jacking up your retention ratio from 0 to 60. Okay, now think of it like this. Have you ever wondered why when company A takes over company B, why is it that sometimes they pay a huge amount to do that? And quite often the reason is, well, company A thinks company B is very poorly run, and it hasn't completely realized its growth potential. You know, it could be bad management. Managers are lazy, or they have a bad strategy. They don't know how to manage the business in the most optimal way. So company A thinks that when they purchase company B, they can turn it around and actually maybe improve the return on equity from 12.5% to 15%, and then they think they can do that, and they also plan to retain and reinvest 60% of that realized potential. Okay, and then they calculate, all right, well, then we think the share price should be 57, And therefore they would go out and tell the shareholders, by the way, if you let us take over your company, we'll pay you $17 extra. Okay, well, they might not pay that much. Maybe they'll pay 12 or 14 or whatever. They would probably want to leave something on a table, okay, for themselves. Okay, but they are happy to pay higher because they think that in running a company in a different way, they can unlock, further value. That's if you understand that, you understand a lot about stock valuation and capitalism, I guess. Okay, so that's what this Pvgo is all about. Okay, it's just used under different circumstance to try to estimate how much further value you can unlock if you really were able to take the company over, for example. Okay. Now, so I think I've answered the this question. I have also answered this one. So you retain. It's not the retain. It's retain and reinvest. So you retain and you reinvest if and when your return on equity is actually higher than the discount rate that you might use. Okay, or maybe the market doesn't think so, but as long as you think so and you have that conviction, that's all that matters. Okay. Now, I've also, I think, to a great extent, answered the last question here, this one. Okay, and I'm now going to tackle this one here about information leakage and market efficiencies. All right, so just take a moment to read this one. Now, the thing about market efficiency and information leakage is as follows. Okay, so this is the so first of all, what is going on here? Well, somebody, some academic study basically looked at whether it is possible to earn extra profit simply by waiting a number of days before there is an announcement, and they took an average. So this is, I know on the y-axis it just says cumulative and normal returns. These are just axis labels. Don't worry about whether there is average or not. But what they did was they took, let's say, 100, 200 companies, and they analyzed each of them according to the price pattern 2 weeks prior to an announcement, and then they just averaged them out. Okay, so the average here is of all of the companies where each of them would have some kind of abnormal return, if there is one. Okay, now what is going on here? So let me first of all try and define, and again, you should already know this. So now first of all, when you talk about efficient market hypothesis, okay, there is there's the strong form. Let's just talk about that first. Okay, now strong form says it is not possible to make any abnormal profits with any information. Okay, and semi-strong just says it is not possible to make any extra profit with just public information, public info. Okay, now if the market was strong form efficient, let's just say it is. If the market was strong form efficient, it means that even insiders are unable to make extra profit. Now, how do you just take a step back and think, how, if you were an insider, how would you make abnormal profit? Think hard, okay? Really put yourself in that situation and imagine if you were an insider, okay, and how can you make extra abnormal profit? And what do I mean by abnormal profit? Okay, so you maybe you don't even need to be in a stock most of the time, but just round about the times of earning announcement, 2-3 weeks before, suddenly you buy that stock. This is perfectly illegal, by the way. Okay, but let's say you were able to do that. Now, let's put the legality aside. Are you able to make money? Okay, even though it is illegal. Okay, are you able to make money? And the whole point about this graph here is you see that there's the price doesn't go anywhere, but suddenly 2 weeks prior, it seems to sort of go up little by little, and then suddenly it just goes whoomph and all the way up there. Okay, now what is a graph like that actually telling you? Okay, now this is basically telling you that some people, quite likely the insiders, have kind of cheated a little bit and stolen the thunder and started buying. And not only are they buying, they are telling secretly their aunties and uncles and mums and dads and boyfriends and girlfriends. So more and more information gets out to the market, and as more and more people start bidding up the stock price, bidding, and it starts rising and rising and rising until the actual day of the announcement, when everyone knows there's an instantaneous reaction. Okay, and then it just goes boom all the way up to this level. Okay, now if this is what is really happening, okay, I think it tells you that the market is not really strong form efficient. Okay, if the market was strong form efficient, then probably you couldn't have insiders like this buying, and then there's information leakage also. The information is leaking out. Okay, now please understand, because I know the question here, I think this student may be a little bit confused here. There is no need to have information leakage because there's no information hidden. Now, I wouldn't say that, because regardless of whether markets are efficient or not, okay, let's just put that aside. Okay, put that aside. Let's not discuss market efficiency. A company will always have confidential information. Of course it does. Okay, every 3 months it has confidential information that you don't know, which are the earnings, when earnings season comes. So a company will always have, I wouldn't say hidden information, but just confidential information that it needs to release, whether it's on earnings or whether it's about to go bankrupt or a new drug that is likely to be successful or complete failure. A company always has information that you don't know. Okay, so really the question is whether insiders can profit from that or not. Okay, now if they cannot profit from it, it could be that any information, including inside information, is already reflected in the stock price. Now, I find that very hard to believe. Okay, so if insiders cannot profit from inside information, I think it's just that by law they are prohibited from trading on that, or maybe not. Maybe they're not prohibited. And how do I know? Well, this is kind of telling you. Okay, that there is information. Some people are trading, and not only that, information is being leaked out. Okay. Now the question then becomes, what if? So if you are happy to accept that markets are not strong form efficient, what about semi-strong? Okay, are market semi-strong form efficient? Now the question then becomes this: if markets are semi-strong form efficient, then you should not be able to make any extra or abnormal profit from just publicly available information. Okay. However, if according to the graph that I showed you, okay, if around earnings seasons, uh, you know, stock prices of companies with, surprise earning surprises, these are called, or good news, if they really do behave like that, now you tell me, you take a step back and think for yourself. If I am an investor and I see this kind of price pattern, okay, can I make extra profit? Well, of course you can. You just have to trade somewhere around here. Okay, somewhere. Can I draw on this? No. Somewhere around here. Okay, if you have a little system that you put in place, of course you can't. Maybe you can't trade here. Okay, you can't trade here. Okay, maybe you want to trade somewhere here. Okay, whatever. I'm just making a simple example. You see that the price starts to rise a little, and then you think there's still some. It still has some more. It hasn't run out of steam yet, so you want to. Here is where 1 week prior, if you see that the week before the stock price has moved up X%, you trade some more. Okay, now let's just say you can do that. Let's say you can. Okay, then that by itself would, I think, invalidate the theory that stock prices are semi-strong form efficient. Because if they are semi-strong form efficient, I tell you what should be happening. What should be happening is this. Okay, so the price is pretty much random. I'm not saying they don't go up or down, but they should be random. And on the day of the announcement, it does this. Oops. It should be a vertical line. Sorry, it's hard to draw. So instantaneously, it just goes up. Okay, so then it's a pure guessing game, because sometimes if there are earning disappointments, it could go the other way. Okay. By the way, sometimes stocks can do this. So they just, because there are insiders selling, okay, so they sell and the price is gradually dipping, and then on the day of the announcement it just goes instantaneously for a dive in the pool, and then it goes sideways. Okay, so my conclusion is, if you see this kind of a price pattern, so first of all, the insiders are certainly making profit, and not only that, even if you were an outsider and this kind of pattern persists, it is it may just about be possible for you to come up with a system where you think that, all right, well, if this momentum continues, it's likely to just keep going. Okay, that's what we mean when we say that markets are not uh, efficient. If markets are not efficient, it means that you can make guesses, and you know, more than 50% of the time you guess correctly, let's say. Okay, that which means that it's not purely random. Okay? In the end, that's really what it boils down to. Okay, um, or to take that even one step further. Okay, just for your interest, it means that even if you were able to guess only 40% of the time, let's say you have another system, okay, where you can guess and you are only right 40% of the time, but 40% of the time you make big money, and 60% of the time when you are losing small money. So end up you have a positive expectation. That would also, invalidate efficient market hypothesis. All right. So I hope that helps everyone. Now, just one last point. I guess if you buy the stock here, okay, and you just hold on to it, you buy the stock here, and then you hold on to it, and then on the day of the announcement, it's or shortly before, it starts rising and rising and rising, and on the day it does this, Now, you are not making a abnormal profit here, okay? You are just making what everyone else is making because you bought the stock here. You didn't have any extra information. You are just taking the risk. You are taking the risk that everyone else is. I don't call that is not called an abnormal profit, okay? Abnormal profit is if you somehow are able to rely on certain signals that you think is present in the market that will help you predict the direction other than random. Okay, and of course that is precisely what the efficient market is saying. It's purely random. Okay, if you are able to predict the market in some way which is not random, which would then allow you to go in and out of the market as you wish according to your little trading rules or trading system, okay, then you can make abnormal profit, because you will buy on dips and you will sell at peaks. Okay, all right, so I hope this is helpful for you guys. I spent a lot of time explaining this because when I saw this question, and again I'm very grateful for it, I started to realize there is a possibility that some of you do not understand entirely the concepts behind some of these lectures, and I think by explaining in such level of detail, it should be helpful for those of you who may have had some misinterpretation. All right, so hope this will help you. Again, thank you kindly for your attention. Thank you very much. Take care.